No, I think looking at December versus November, and one of the things that's been brought up recently is just the fact that we've got a bit more confirmation on the strength of consumer activity and health of the consumer through the end of December. That's given, I think, investors a little bit more confidence that they can go ahead and just be a little bit more optimistic through the end of the year and about the Fed's intentions. So, with just a few more trading days left, with the U.S. markets being a little bit sleepy, with the main holiday having been on Monday. There's a chance that we see a little bit more lift, but with a lot of the major news having already come out, there's a good chance that this is sort of, the last bit of the coast of the of Santa's sleigh.
And moving into next year, I mean, one of the key elements, of course, still continues to be the Fed. Plus, you have the Magnificent Seven on the other side of that. Then, I mean, what is the base case here? I mean, we seem to have a soft landing pretty much priced in for the most part, but pain still looks to be ahead. I mean, you still have a high interest rate environment. Inflation hasn't necessarily dipped off, and a 150 basis point cut in interest rates for the whole year still puts them relatively higher.
hmm hmm Yeah, I think base case is really that we still continue to see companies that are generating a significant amount of cash flow and have healthier balance sheets and fundamentals continue to do well. Because when you're in a structurally higher interest rate environment, even with, as you mentioned, that 150 basis point cut, that's still going to sort of draw a line between the haves and the have-nots, and the haves being, the most flexible, prepared, well capitalized versus the have-not. So I think base case is that we do start to see some of the effects of sort of the lagging events that happened this year. We had a number of strikes. We have the resumption of student loan payments. So we will probably start to see that kick in. And then also the fact that even if money becomes a little less expensive for companies, I think investors are a little bit more cautious around just going ahead and selling out that capital because they are going to be focusing more on operators. So I do think that base case is a little bit more scrutiny and still a slightly tougher environment for the companies seeking out equity investment, even with a slightly healthier consumer environment.
Shelby, let's talk a little bit more about Main Street. It is, again, another shopping period that we've kicked off thanks to yesterday and Boxing Day sales. You expect a slowdown into next year. What changes of behaviours do you anticipate next year as consumers watch what they're spending their money on?
hmm I think going into next year, what I would expect, along with that sort of continued decline in savings versus debts and just regular, free flowing cash through consumer accounts, is really just a decline in some of those more discretionary purchases, some of those impulse purchases, and probably a greater focus on things like services and experiences, things that have experienced maybe just a tad bit less inflation, maybe not necessarily things like concerts, because we do see that those tend to be a little bit frothy in valuations. But consumers looking a little bit closer at the checkbook, realizing that there is not as much surplus cash and having to adjust accordingly. So I would sort of expect, some of the promotional periods to still be robust. We've seen that data still backs that up. But we have also seen the sort of slowdown in those in between lull periods. But there's not as much desire to get out and make these sort of exciting, more discretionary goods purchases in between these normal holiday periods.